Good afternoon and welcome to the FX Week Ahead HYCM's webinar with myself, Giles Coughlin, Leaf Live Market Analysis. We'll be looking ahead in this coming week with the things that we have up, and we have a lot coming up this week. So it's an exciting week to be looking ahead. Before we really get going, I'm just going to wait for people to join. Just going to say hello to folks. Hello Nadir, Ravi, Van, Thaddeus, Vincent, Ida, Hashik. Yeah, good to see you guys. I can hear you hear me well. Oh, that's super as folks are coming in. There is a lot to look at this week. We've got three major central banks meeting this week. We have the Brexit negotiations, which are potentially reaching the end, or either the end of the negotiations in a deal or an extension of a deal. We also have rumours of the US-China trade war perhaps coming to an end as well. So you put all those different factors together, we could see some significant moves in the FX markets for this week. Before we get going, just going to put the disclaimer up at the front. Obviously, as I'm looking at different trade setups, entries, exits, moving average, difficult technical areas, this is not trading advice. So the whole aim of the webinar and the workshop that we do tomorrow with HYCM is to educate traders to make informed decisions so that when they're trading, they're doing it from a position of knowledge rather than ignorance. So the aim of this time is not trading advice. It's simply to educate people to see how they can make trading decisions for themselves. So the idea is that you can listen to the way that I analyze the market to help to begin to inform and direct you guys how to make your own trading decisions. So that's with that being said, and some more folks coming in, we're going to get into the week ahead live market analysis that we have. So first of all, we need to look back at last week because there were some significant moves in the FX sphere last week that we just need to recap ourselves on because they influence this week. The Fed Vice Chair Richard Clarida was speaking in Washington, and he was saying that basically what he was really confirming was that the Federal Reserve is going to continue with its role of patience. You see, it's this phrase here, the patience makes its way into the Fed speech statement. So the Federal Reserve recently have paused their cycle of rate hikes, and they're just saying, we're going to wait and see if the data confirms or warrants us raising rates in the future. So it's that pause, that wait and see. Now, some of the difficulties of the wait and see mode that the Fed has been in is that we had the US government shutdown at the start of the year. So that means that's affected a lot of data releases coming out of the US. So the Federal Reserve now is saying we want to see what the data says. The problem has been the data has been less reliable, particularly the early data. We're starting to get into a scenario now where the data from this point on is going to be less affected by the US government. So that's just to say that the Federal Reserve was sending out the same message through last week. So we're data dependent. So in our minds as traders, we think, okay, the US is now data dependent. So we need to view any incoming data as though we're viewing it through the Fed's eyes, and that helps us to interpret the path of the US dollar. Now, Theresa May has been carrying on trying to negotiate a Brexit deal with the European Union, and over the weekend Brexit supporters gave Theresa May 3 tests for an EU deal. Okay, so these are some Brexiteers that really favour kind of a hard Brexit. They're saying, okay, Theresa May, we can see that Jeremy Corbyn has moved the ground by saying that he's open to an extension, he can do everything he can to avoid a no deal, even up for a second referendum. So some of those within Theresa May's own party have said, okay, well, if you satisfy these 3 tests, then we'll support the deal. So that happened over the weekend, and that's why the pound has been bid since the open of the Asian session last night. It's this confidence that's entered the pound through the Asian overnight session. And just to summarize ourselves, there's meant to be a significant vote on or before March the 12th. So by this time next week, by Tuesday next week, there should have been some vote about whether Britain is going to remain in the EU or whether Britain is going to extend Article 50. So the thing to note here is it's coming towards the climax of either a deal being negotiated or the Article 50 being extended. So we're really entering crucial times. Remember, March the 30th, the end of March, is the final date by which Britain has to either negotiate a deal with the EU or extend Article 50, or else there's a no-deal Brexit. So a no-deal Brexit would result in the pound being sold off heavily. So we'll look at the pound in a little bit more detail at the moment, but just to say that we're getting to the crucial moment, so we need to be alert, particularly for headlines or shifts in sentiment. There could be some volatility in the pound ahead. Basically, the odds of a no-deal Brexit have reduced. So looking at the pound-US dollar pair, this was a trade that I took, I think last week, 25th of Feb last week, 26th, 27th, going into the end of the week. This was basically on Jeremy Corbyn saying that he was going to do everything he could to avoid a no-deal Brexit and was wanting to open up the idea of a second referendum in Britain. The referendum would be asking the British people, do you really want to leave the European Union? So the pound was being bid, particularly on that hopes of a no-deal Brexit being avoided, and particularly on the hope of an EU referendum. So that was quite a simple and straightforward trade at the time. It just goes to show you, when you're linked in and you're hooked into the news, you can quickly detect a change or a shift in sentiment as it occurs. So the likelihood now, we're only dealing with likelihoods. We can't deal with certainties ever with the markets, because the market can always surprise you. There's always a possibility, so you have to deal with probabilities and likely outcomes, because certainties are not there in the market. So the likely outcome is now seen as either there'll be a deal or a delay. Okay, so the pound is likely to continue to be bid. The two different scenarios, we have a 2 to 3 month delay, that's option 1, or a 9 to 12 month delay, that's option 2. So basically, it's deal or delay. So we're getting into a situation where we know that the chances of a no-deal Brexit are very low. Okay, so let's look at the pound-US dollar pair, and we'll quickly look at the pound-US dollar pair. And as we're looking at it, we can see, from a swing trade perspective, if price returns back down to this 61.8% level, that would be a very interesting area that I would personally be interested in going long. If price retested this 250 100 exponential moving average, which is also the confluence area, the 61.8% fib retracement level and the 50% retracement level. So that's what I'd be looking at, as long as this scenario remains, as long as it's either a deal or a delay. Because if there's a deal, the pound will rally, okay? And the pound will rally on a deal probably up to around 1.35, you could expect, okay? So let's look at these, going into the closing elements of this deal. We want to start getting down to some detail. So if there is a deal, we can look at 1.36 as a first point of call. Okay. If there is a 2 to 3 month delay, what you're likely to see is a rally up at least to these highs, maybe as far as the 200 exponential moving average, or maybe just up to this kind of in between region there. I have to look if there's a pivot point or something that would be helpful. If the deal is going to be more like a 9 to 12 month delay, again, we'll be looking at this higher levels, 1.36, 1.37, that kind of region as a first port of call. So I think there's a lot of upside for the pound now, and there's less likelihood of a no deal. And remember, we'll only know if the no deal happens on the 29th of March. It'll be heading into that. We might get a little bit of advance notice. Just be aware, volatility in the pound, and that is opportunity. So that's key aspect to be looking at. And one of the rumours that I've been hearing is that Theresa May might offer an extension earlier than next week. So we might see an extension earlier this week. That's the rumours that I've been hearing on the wires. So make sure that if you see that that deal comes in early, that's a quick opportunity to jump into the pound, okay, and buy the pound. Okay, just to remind the importance of needing to secure a deal. The Bank of England's Mark Carney, it's Bank of England's governor, he's warned of the huge business investment decline that there has been in the UK as a result of Brexit. He sort of said, you know, investment across the rest of Europe have been pretty robust, pretty good, and the only logical reason he could see the decline in investment was Brexit uncertainty, and I think that's a very fair assessment. Businesses want certainty, and before they, you know, build new headquarters, employ new staff, take on new infrastructure, you want to know, well, is Britain going to be remaining in the EU, or would we be better off moving our headquarters to Brussels, or we'll hold back on increasing our staff just now. So you can see each quarter, you know, the business investment has been going down through 2018. You can see where it's tailed off towards the end of the year. So business investment is going down in the UK. So Britain really does need to get a deal. So a deal or a delay, a short-term delay, is not going to help this lack of business investment. So it's worth reminding ourselves that the anticipated Brexit delay will hurt growth. Okay, so this is something for a more medium-term outlook. It's something to hold in the back of your mind. And you can see here, looking at the yellow line, if the impact on a 6-month Article 50 delay, they see the 6-month delay being as much as 0.5% of GDP, maybe 0.4% minus GDP on a Brexit 6-month article delay. And you can see the anticipated recovery there taking, you know, nearly over a full year to begin to pull out of that anticipated nosedive. Now remember, this is obviously not what will happen. This is simply what's projected could happen. But the key thing to understand is this is the market's expectations, and so the market will be trading in line with those expectations. So some good data was out for the US last week. The fourth quarter advanced GDP came in a great beat at plus 2.6% versus 2.2% expected. Remember, the Fed is going to be watching the US data carefully. We saw the dollar-yen pair rallying quite strongly on this data towards the end of the week. We'll just call that open. So you saw quite a strong rally towards the end of last week, and there's confidence for the US data, and obviously there's a lot of yen weakness with the risk-on situation in the market. We'll return to that later. So that's just to clock that good fourth quarter advanced GDP data that came in. Yeah, Caxin private PMI data showed potential signs of bottoming out. This is out of China. This is the private purchasing managers index, and you can see it is the black line here. You can see China, it's the black line there, and you can see that it showed signs of bottoming out by pulling a 49.9 reading, still below the 50, so still in contraction. However, you can see that it's bottomed from January 2019's low, and so that was a little bit of encouragement for China. We've covered this a number of times. The US-China trade war has been weighing on global growth. It's been weighing on Chinese manufacturing, and this private purchasers managers index is showing that maybe is the worst behind us. The market certainly rallied on that relief, but that's just to be aware of. It's still in contraction, but you know, the jury is out, as it were. Remember the relationship between the Australian dollar and China data. So I just wanted to show you that when this data came out, 49.9, there was a recovery in the Australian dollar because investors thought, oh, this is not so bad. It's not carrying on as bad as we thought. So there was a relief rally in the Australian dollar. The Australian dollar was bought, but then it was sold off in line with the wider trend, because although the manufacturing index was slightly better than expected, you can see that the trend is still down. Okay, so that's a good example of the short-term sentiment. The short-term mood was strong for the Australian dollar, but the longer-term macroeconomic picture meant it was a sell. So that's just a good lesson, which I wanted to put that in for you, how you sometimes marry sentiment and fundamental analysis together. It's a concept we're looking at on the workshops on the Tuesday. So that was just a good example of that for us to see. Now, an interesting piece of data out last week was the fourth quarter Canada's GDP. Now, this was plus 0.4% on the quarter versus 1% expected. So this was the slowest GDP data since the second quarter 2016. Okay, so this was a very poor reading. The investment and the spending in the Canadian economy was down minus 10% for non-residential capital spending and minus nearly 15% for residential investment. So this is really, really poor numbers. It was a really, disastrous reading for Canada, and we saw some strong reaction in the US dollar Canadian dollar pair, and this is a trade that I'm personally very interested in. Again, it's not advice, but it's just showing you how you marry these things together. There was an interesting situation, and the data was actually released early, and the early release meant that the Canadian dollar was bid into the official release of the event. In the end, they just released the data early because they realized that some people had already got hold of the data. Now, the Canadian government can, from time to time, make an error with data releases, so it's worth just being aware. Sometimes they have released the information early. This was the bar, the 1 hour candle, and when that one hour candle stick broke, the US dollar was bought strongly against the Canadian dollar. Now, the reason is the Canadian government has been quite confident recently in their outlook, and a number of central banks, almost all central banks, have been less confident, less hawkish. So all of a sudden, the Bank of Canada was out on a limb, and this GDP data is just a big reminder to the Canadian government that actually you're in the wrong place. And so that's why the Canadian dollar is being sold, as traders realize that this GDP data, low business investment, low quarterly GDP results, this is not what the Bank of Canada wants to see. So the Bank of Canada may be shifting to a neutral or a rate cutting scenario. That's why the Canadian dollar is being sold. That's why you can expect the Canadian dollar being sold into the meeting this week. So we've spoken about before, you sell the rumor, you buy the fact. This is one of those scenarios where we're selling the Canadian dollar into the rate hike meeting. It makes sense. Again, looking at this trade from a longer term perspective, you can see you've got a bullish outside bar on the daily chart, rejecting the 200 exponential moving average, an entrance on the break, stops below and targets up above at the 1.35 and above level. That's a straightforward trade. Similarly, on the weekly chart, we have a bullish engulfing outside bar, rejecting the 50 exponential moving average. We have strong reasons for the Canadian dollar to be sold, some good reasons for the US dollar to be bought. Entrance on the break, stop beneath, take profit at above 1.3500, maybe 1.3650. So that, again, that's not trading advice, it's just showing you how you put these things together. And last week offered a good opportunity for a good swing trade, which will suit many of you guys who are unable to be at the market, all the time. You can't be at it for every session every day. You can maybe jump in during the day, after work, before work. You're just managing your trade. This is an ideal swing trade example to show you what is possible. But again, it's not trading advice. It's just for education. Now, geopolitics, big news that the US-China trade talks. Wall Street Journal was saying that they're really close to a deal. Bloomberg was reporting that sources close to the matter were saying that a deal is nearly there. There was a large rally in the overnight Asian equity markets. We had plus 1.12% of the Shanghai, Hang Seng up 0.5%, Sensex up 0.5%. The Nikkei Japanese indices was up plus 1%. Anytime there's a increase above 1%, that's an interesting figure, something to pay attention to as a significant rally. Going in the moment, the London session, we have the FTSE up 0.82%, dollar index up 0.12%. We got 10-year yields 1.62%, and we got S&P 500 futures up 0.28%. So some of that good, risk-off tone is followed through from the Asian to the early morning European, and now we're heading into the US session. The strongest currency towards the end of the European session is the British pound. Was strong. We know why that's strong. The Canadian dollar was strong, but you need to remember that the Canadian dollar is likely to be sold off. The Canadian dollar, New Zealand dollar, Australian dollar were benefiting from their risk-off status. They're some of the beta commodity currencies. They tend to be bought in a risk-off environment. The risk on, the safe haven currencies like yen and Swiss franc have been sold off, which is what you'd expect in a risk-on environment. So, we're expecting to see yen weakness as long as this optimism about the US-China trade war carries on. So, buying a currency against the yen makes sense given the situation of the market. Two big issues. There's 2 sessions. China's biggest political meeting of the year to occur between now and tomorrow. Expectations is markets looking at this meeting to say, how are you going to do, China? How are you going to respond to your slowing economy? What kind of information are you going to give us that's going to affect the data that we're looking at? Just to be aware that those potential headlines could be crossing the airwaves. Then the next, this is it. What we need to look at now is the FX week ahead. So we want to look at the key data, and there is some really key meetings taking place. We want to look at those. So we'll go to the calendar. Now, looking at the calendar, it's quite quiet for the rest of the session. We haven't really got particularly much coming on into the US session. The first significant meeting we have is the Reserve Bank of Australia's rate statement. So we've got their rate statements, their interest rate decision, and we have at the end of this day, we have Governor Lowe speaking. So remember, when you have a rate statement and the governor speaking, if the rate statement is misinterpreted by the market, or the governor thinks the reaction of the market is wrong, that is a opportunity for the governor to address or to change his guidance. So what you need to be aware of is that rate statement and interest rate decision and Governor Lowe's speech come as one risk event. So you need to be aware of that. Now, what's expected is for the Reserve Bank of Australia to start becoming more negative, more bearish on their outlook. So that's what the market's expecting. And the market will be reading that rate statement to see, does the Reserve Bank of Australia change their guidance? I think there's a slight risk of a rate cut. That could be something that the Reserve Bank of Australia do. That would be a big decision, and Australian dollar will be sold off quickly. So to be aware of that, there's a risk of a rate cut there, and the market's expecting a more bearish outlook from the Reserve Bank of Australia. So we'll have to see what happens when that occurs. Going into Wednesday, we have some GDP data out of New Zealand. So again, that will be looking at, it's a key indicator of growth. So the market will be looking at how New Zealand's growth is taking place. If there's a big deviation from that figure, it will likely have a reaction, whether it's down or up. The market has been surprised by the increased, or the lack of bearishness from the Reserve Bank of New Zealand. So the GDP data will be eyed carefully, and one to look at particularly for a deviation. If it's on estimates, it shouldn't have too much of a reaction. Then the interesting one is the Bank of Canada's interest rate decision. This, for me, is the most significant event. I've already mentioned about the weakness in the Canadian dollar. This will be the opportunity for the Bank of Canada to communicate to the market any concerns it has, if it's going to be a slowing, if it's going to be cutting rates, if it's changed its outlook. So at the moment, that weak GDP data means that the market is expecting the Bank of Canada to give some kind of alterance in the forward guidance. Remember, the US dollar Canadian dollar pair is a good pair to trade on the back of that rate statement. Going into it, we've seen a bullish outside bar on the weekly and the daily chart. Both the highs have been broken, so the market is selling the Canadian dollar against the US dollar into that meeting. That's something to be aware of, and obviously the rate statement will be very, very significant. Then the next central bank meeting we have is an interesting one. We have the GDP data out of the Eurozone, and we have the ECB rate decision. Okay, that interest rate decision still expected to be at 0%. The last communication from the ECB has been the next move that we're going to do is going to be up in the summer of 2019. Right, now any change from that will be eyed very carefully by the market. The Eurozone has been slowing down, and the market's wanting to know how's the European Central Bank going to react, if at all. Remember, with this rate decision, you've got the rate decision at 12:45 GMT, and then at 1:30 you've got the monetary policy statement and press conference. So don't forget that these events are kind of, that you need to view them more like one event. I've seen many times you've got the rate decision moves the euro one way, and then Draghi comes and speaks in the policy statement, and he moves it the other way. So be aware. Don't just trade the rate decision. Also look at the monetary policy statements as well, because they should be seen as a joint event, really, even though they come at separate times. Then we got some more data out for the Eurozone in the morning. Again, that will be viewed. We got some trade balance and imports data out of China. Remember the 2-session meeting that's taken place, it should have finished by then. And then we've got the non-farm payrolls and some more employment and unemployment data out of Canada. They're the big events for Friday. Again, the market is honing in on a US data, and they'll be interpreting that for how the Fed is going to react. So really the key events, and obviously Saturday you've got the Fed's Chair Powell speaking, that can move the market, and you've got CPI data out of China. Remember the key things, it's these central banks, and these central banks are likely to move the market. Traders will be looking for near-term and medium-term direction from their statements. So that's the things to carefully look at. One last thing to mention is February was a good seasonal month for oil. I was flagging up with my reasons for taking an oil long trade last month, and March is all. You can see that oil is very seasonal, tends to appreciate February, March, April, tends to depreciate October, November, December. So you can see that seasonal things are in place. The oil market itself, we've got falling US oil rigs. We're getting good OPEC participation in the cuts. Saudi Arabia, Russia are participating in cuts. There's problems in Venezuela that is affecting oil supply. So you put it all together, there are still some good reasons for US oil to be bid. So looking at the US oil chart, sorry about this. Just looking at the US oil chart, you can see here that on the daily chart, there's a 200 exponential moving average here, and the resistance level that prices moved against there, and prices currently found support on a pivot point. So that could arguably, for a long, stopped placement of that pivot point, first target up to the 59.26 level would make sense. Or in a more conservative traders or a shorter term trade, breaking above these highs in the pivot point, stops below the low here, 55.71, playing up to 57.36. There's two different options there. Again, not trading advice, but trying to put the different pieces together that we have. Okay, guys, thanks for joining me on the FX week ahead look. Now, tomorrow we have a 1 to 2 o'clock. We have the online trading workshop. We'll be looking at some of these situations in more detail tomorrow, and we'll be going through how to begin to interpret and understand the market on a day-to-day basis, on an intraday basis. Tomorrow we'll also look at a swing trade tomorrow as well. So that's tomorrow, 1 o'clock to 2 o'clock, and I hope you guys are going to be able to make it, and I look forward to seeing you there tomorrow 1 till 2. Thank you very much for attending, and I look forward to speaking to you guys tomorrow. Goodbye and take care. Thank you. Yeah, cheers, Nadir. Take care now. Bye.